Welcome to this introduction to Chapter 8, which is about the interest rate and production in the short run. I'm Nils Gottfries, the author of the book Macroeconomics. And now we come to part 2 of the book, which is about the short run. And this part is concerned with fluctuations. And we see in this picture that GDP growth this is for the US. It has varied quite a lot. In some years, the growth has been 5 or 6%. In the financial crisis in 2009, there was a decline of GDP of about 4% in 1 year. If you look at inflation, you see that it's mostly positive, but there have been a couple of years with negative inflation rates, and sometimes inflation has been as high as 13 or 14%. So prices and quantities vary quite a lot. And now we're interested in what can cause these fluctuations. So a few words about the difference between the long and the short run. So when we analyzed wage setting in the long run, we made this diagram that has unemployment on the horizontal axis and an individual firm's relative wage on the vertical axis. And then we drew a curve showing the desired relative wage of an individual firm. And we said that if there's very high unemployment, then each individual firm will say that, well, we're not very afraid of losing our workers. We'd like to reduce our wage compared to the general wage level in the economy. So there will be downward pressure on wages. On the other hand, if unemployment is very low, then there will be upward pressure on wages. And this means that there is some kind of equilibrium level of unemployment where firms neither want to raise nor reduce their wages relative to other firms. And we call that long-run equilibrium rate of unemployment the natural rate of unemployment. And this wage pressure will push the unemployment rate towards that level. And if we combine that with the production function and we take the labor force and the technology and the capital stock is given, then we get the natural level of production or the long-run equilibrium level of production. And when we analyze the long run, we assumed that production is on this natural level. But of course, this wage and price adjustment doesn't occur instantaneously. There is clear microeconomic and macroeconomic evidence suggesting that wages and prices adjust slowly, and that evidence is discussed in the book. And when wages and prices adjust slowly, this means that in the short run, production and employment may be above or below the natural level. So we're now going to analyze fluctuations around the natural level of production. So we're not saying that wages and prices are absolutely fixed. Of course, they adjust and they change all the time. But we're saying that they move slowly, and therefore it is interesting to analyze situations where production is not on its natural level. So let us consider the difference between the long run and the short run. Well, remember that when you do economic analysis, what you often do is you have an economic model and you use that to analyze what happens if there's some kind of exogenous shock. And then you can do that analysis looking at the long-run effects or the short-run effects. So if you're looking at the long-run effects, then you typically assume that prices and wages adjust to that exogenous shock, and you assume that production is on the natural level. And that requires, of course, that the real interest rate is equal to the natural rate of interest, because that is required for demand to be equal to production at the natural level. But when we analyze the short run, we assume that prices and wages are sticky or adjust slowly. And we assume that production is determined by demand. So firms look at how much they can sell, and there's no reason to produce more than they can sell. And as we will discuss in this chapter, the central bank can control the interest rate by adjusting the money supply. The central bank controls, of course, the nominal interest rate, and the expected real interest rate may be above or below the natural rate of interest. And we can also see it if we consider the two equations that we have already seen. One describes the goods market equilibrium. Production equals consumption, which is determined by the consumption function, plus investment, that is determined by the investment function. And the real interest rate that determines consumption and investment is the expected real interest rate, which is interest rate minus the expected rate of inflation. And then we have the money market equilibrium, which says that the real supply of money equals the real demand for money, which is production divided by velocity, which may depend on the nominal interest rate. And when we analyzed the long run, we took the prices as endogenous and assumed that production is on its natural level. And that meant that if the money supply increased 10% and everything else was constant, then the prices would increase also 10%. But now in the short run, we assume that the prices adjust slowly, and that makes production endogenous in these equations. So it is determined now by the level of demand, and it may be above or below the natural level. So chapter 8, the interest rate and production in the short run, the ISLM model. So in this chapter, we look at the goods market equilibrium, and we discuss the multiplier effect and the IS curve, which describes the relation between the interest rate and the level of demand in the economy. Then we look at the money market equilibrium and the LM curve, which describes the relation between the level of production in the economy and the interest rate that you get in the money market. And then we take these two equilibrium conditions together, the IS and LM curves, and we then have a model, the ISLM model, that we can use to analyze the interaction between markets for goods and services and the market for money, for the loans, and we can analyze a range of shocks and how they affect those markets. So this chapter is focusing on the demand side of the economy, and we take the price level as given. In the next chapter, we look more at the supply side and wage and price adjustment so that we get a theory of both demand and production and wage and price setting in the short run. So let us start with the goods market and the multiplier effect. We use an equation that you have seen, which is that production is equal to consumption plus investment, and we have the consumption function and the investment function. Consumption depends on current income, expected future income, the real interest rate, and the level of assets. Investment depends on the real interest rate, expected future income or demand, and also on how much capital you already have. And the real interest rate is interest minus inflation. Now we're looking at the short run. Think of this as a particular year, 2016, and you have some nominal interest rate, I. And you don't know what inflation will be from year 2016 to 2017. So pi e is the expected inflation rate over the coming year. When we looked at the long run, we typically assumed that you had the correct expectation about inflation. But now, as we look at the short run, we don't impose that people always have the correct expectation. We just say they have some expectation about inflation. Now, for a given real interest rate, we can illustrate the goods market equilibrium in this graph, which is called the Keynesian cross. On the horizontal axis we have production, and on the vertical axis we have aggregate demand in the economy. If we look at consumption, if we take the interest rate as given, assets as given, and expectations about future income as given, then we can draw the consumption function as an upward sloping function, because we know that if today's income increases, then people will consume more. And the slope of that function, so that's this function, the slope of this function is the marginal propensity to consume. So if we increase production by 1 unit, how much does consumption increase? Well, that's the marginal propensity to consume that we talked about in chapter 4. But then demand in the economy is not only consumption, but there's also investment. So if we add investment to this, then we get a line here which shows the total demand, consumption plus investment. And again, remember, this line is drawn for a given expectations about future income, given real interest rates, given assets, given capital stock. And now we can ask, what is the equilibrium in this economy? Well, if firms produce what is demand, then the equilibrium level of production is Y0, because that's the point where the demand in the economy is equal to the actual production, because we've drawn here a 45-degree line that shows production. You can think of it as showing production as a function of itself. For every given level of production, we have measured production on the vertical axis, and that becomes a 45-degree line. And the only point where you have an equilibrium is when demand in the economy is equal to production, which is where this aggregate demand schedule crosses the 45-degree line. So this is the short-run equilibrium level of production for a given real interest rate. And that level of production may very well be below the natural level of production. In this case, I made the diagram so that the short-run equilibrium implies a level of production below the natural level. This will happen, of course, if the expected real interest rate is higher than the natural rate of interest. In the long run, we always assume that the real interest rate was equal to the natural rate of interest. But if the real interest rate is too high, then production will be below the natural level. And if the real interest rate is too low, then, of course, production may be above the natural level. So let us now consider a shock. Suppose that there is a shock that increases demand. For example, it increases investment by a certain amount, so delta I. There's something that makes investment increase. Well, that will shift up this demand schedule to a new level, and the equilibrium will go from here to here. And the interesting thing you see graphically here is that the shift in this line was delta I, that's this change, but the increase in production is going to be higher. Production is going to go from this level here to here. So production will increase more than the original increase in demand. And why is that? Well, the intuition behind this is that if there is an increase in investment, this will lead to an increase in production. But then as production increases, that will lead to a further increase in consumption, which is also demand. So there will be then again some increase in production. And then that in turn will again lead to some increase in consumption. And that you can see that in the graph, we start with Y0, you have an increase in investment equal to delta I. So graphically, demand goes up here, then production goes up to this point to satisfy that demand. But that is not an equilibrium situation, because at this level of production here, then consumption will increase. So you will get this level of demand. But then to satisfy that level of demand, production will go up here, and so on. So you will get a total increase in production that is more than the original increase in demand. And this is called the multiplier effect, because it says that if there's an initial shock to demand or equal to 100, then actually production will increase more than 100. So investment increases, production and income increase, consumption increases, and production increase and income increase further. And the total effect, if little c is the marginal propensity to consume, then the total effect is delta I times a multiplier, which is 1 over 1 minus the marginal propensity to consume. So the point is, an initial shock to demand will lead to further increases in consumption and further increases in income. Okay, and that is discussed more in the book. So we can also think now of the interest rate. Suppose that we increase the interest rate. What happens? Well, we know that consumption and investment are functions of the expected real interest rate. And now I've written those function, consumption and investment, as functions of the real interest rate, which is the nominal interest rate minus the expected inflation rate. So we know if the nominal interest rate increases, that will raise the real interest rate and reduce consumption and investment. And what will happen? Well, there will be a fall in demand. If we start at this point now, there will be a fall in demand. And how much is that fall in demand? Well, it depends on how much the interest rate increased and how sensitive consumption and investment are to the interest rate. That determines this initial decrease in demand. And then that will lead firms to reduce their production, so income will go down to this level, okay? But then again, we get a multiplier effect, because as consumers see their income going down, they will reduce their consumption by this amount, and that will further reduce demand and therefore reduce production. So production falls to this level, and so on. So we get a decrease in production due to that, and we see that the effect of the interest rate on production will depend on two things. First, the direct effect that the interest rate has on consumption and investment, and then on the multiplier. And this is further analyzed in the book. So we know an increase in interest will lead to a fall in aggregate demand. And that is the IS curve. So the IS curve is a very important concept, and it is a relation between the level of the nominal interest rate and the level of production. And it has a negative slope, because suppose that at this interest rate we have a level of demand and production which is y1. And suppose now we raise the interest rate from I1 to I2, well, we have just learned that that will lead to a reduction in demand and a multiplier effect that further reduces demand. So production will go down, and in this case it will go down to the level y2. So the negative slope says that as we raise interest rate, production will fall. Now, this is nothing strange really, because you can roughly think of the IS curve as a demand function. Recall that 1 plus the real interest rate is the price of goods today in terms of goods tomorrow. And of course, if we take the expected inflation rate as given, then as we raise the nominal interest rate, we raise the expected real interest rate, and the demand for goods today will go down. So that you can think of this as a standard demand function with the price on the vertical axis and the quantity on the horizontal axis. But of course, there is an extra twist here, because we're talking macro and not micro, and we have this multiplier effect, which is a genuine macro phenomenon, that as production goes down, that will lead to further decreases in demand. That kind of effect you would not have on an individual market, but you have it in the economy as a whole, because demand in the economy as a whole depends on the level of income in the economy. But roughly speaking, it's just a classical demand function. Now we turn to the money market. So in this economy, we assume that households have three types of assets. They have money, transaction balances. They lend money to companies to finance investment. And they also own the companies. So they have shares. And for the moment, we just assume that they sit on the shares. We don't discuss the stock market. And in the market for loans, we assume that the interest rate is flexible and the interest rate adjusts so that supply equals demand for loans. But that is equivalent to saying that supply equals demand for money. So we're now talking about the stocks of loans and the stocks of money. If the household is happy with the amount of cash balances that they have, the amount of big money they have, then they don't want to lend any money. But if the household think that they have too much cash, too much money in their pockets or wherever they have it, then they will want to lend it to someone. They will say, I don't want to have the money that doesn't pay interest. I want to lend it to someone. I want to lend this money to a firm to get interest. So in that sense, saying that supply equals demand for loans is the same as saying that the supply of money equals demand. And the equation for that we already have. It says that M over P, the real amount of money, should be equal to the real level of production divided by velocity. And we assume that the velocity is a function of the nominal interest rate because, as we know, the nominal interest rate is the opportunity cost of holding money. So we assume that always the interest rate adjusts so that this equation holds. We assume that in the long run too, but then the prices could adjust. Now the price is taken as given, and the money, we can think of that as exogenous now, and the interest rate being endogenous. And production is also endogenous. So let us first look at the money market equilibrium. In a graph where we have the real level of money on the horizontal axis and the nominal interest rate on the vertical axis. And then we have a given real supply of money, M over P, and we now take M and P as given. So there is some real quantity of money which is out circulating in the economy. And then we have the demand for money, and we know that that depends negatively on the interest rate, because the interest rate is the opportunity cost of holding money. So if the interest rate goes up, then velocity goes up and money demand goes down. So as the interest rate goes up, the demand for money goes down. And then we have the equilibrium in the money market or in the loan market is this interest rate here. So if the interest rate is higher, then the demand for money is lower than supply. If the interest rate is higher, then households want to lend more of their money, and there will then be a downward pressure on the interest rate. And the same opposite happens if the interest rate is too low. So this diagram shows how the interest rate is determined in the money market. And the central bank can control the level of money. So by increasing the money supply, the central bank can reduce the interest rate, as is illustrated in this diagram here. In practice, the way the central bank does that is by lending. So if they lend more money, that increases the supply of loans and reduces the interest rate. That is very simple. So you see immediately here that the central bank can actually control the interest rate by adjusting the money supply. So what happens if production changes? Well, if the central bank keeps the money supply constant and there is an increase in production, what happens? Well, this demand for money, this schedule here, will shift out. Initially we had this level of interest, but at this level of interest, demand for money is going to be higher. It's going to be here. But of course that's not an equilibrium situation. Now, since demand for money is higher than supply, then people don't want to lend so much, so there will be upward pressure on interest rate, and the interest rates will rise. So this shows that if there is an increase in production and transactions, so people need more money, there will be kind of a shortage of money, and that will push up the interest rate. And this is the LM curve. So we can draw that relation in a graph where we have production on the horizontal and the interest rate on the vertical level. And we see that if we initially start with the level of production Y1, and that gives in the money market an interest rate Y1, if production increases to Y2, then the interest rate will increase to I2. And what is going on here? Well, if there is an increase in production, there's an increase in transactions. To carry out more transactions, people need more cash balances, so they are less willing to lend their money. They say, I need more cash balances, please give me back some of the money I've been lending to you. They say that to the firms, and that pushes up the interest rate. That's until people are again happy with their money holdings. So an increase in activity for given money supply will raise the interest rate. And that is the LM curve. And now we can combine these curves to understand the equilibrium, and the only possible equilibrium is where those two curves cross each other. This is point A in this diagram. And it's useful to think of other situations. What will happen if we are at point B, for example? Well, at point B, we are on the LM curve. That means that at that point, people are happy with their money holdings. There's no upward or downward pressure on the interest rate at point B here. But what about the product market? Well, we have a level of production Y2 which is far above the level of production given by the IS curve. And remember that the IS curve gives the equilibrium level of production for a given interest rate. So with this high level of production, it must be that production is above the level of demand. So firms will not be able to sell what they produce, and there will therefore be downward pressure on production. So this point here is not an equilibrium level of interest and production, but production will tend to fall. And you can think also about the point C and what happens if we are at point C. But the intersection point A is where the economy will end up. And you can then use the ISLM model to analyze effects of shocks, that is changes in the exogenous variables. And basically there's a scheme for using the ISLM model that consists of 4 steps that you should always use. So what you do is that you first draw the IS and LM curves, and it's good to have the equations at hand too. And then if you want to analyze a particular shock that is a change in an exogenous variable, you can look in the equations, you see which of the equations will be affected by this shock, this exogenous change. Is it the IS curve or the LM curve, or maybe both? Suppose you find that the IS curve is affected. Then you try to figure out, is the IS curve shifting out or in? So you draw a new IS curve, and then you can see what was the initial equilibrium and what is the new equilibrium, and then you can see what happened to the interest rate, what happened to production. So that's a graphical analysis. And once you have done that, you figured out, okay, the interest rate went up and the production went down or something. Then you can try to work out the economics. So you should use have an intuitive explanation here. What is happening? Why did production go up or down? Why did the interest rate go up or down? In that economic explanation, you start with the initial shock and say which market was affected by that shock and how that, for example, it affected the goods market, and then this in turn affected the money market, and so on. You try to figure out the channels through which things happened. And then you can, after having worked out the effect on production and the interest rate and understood those, then you can also work out the effects on the other variables. You can say, well, what happens to consumption? What happens to investment? What happens to employment? And so on. So in this way, you can analyze a lot of different shocks using this model. So as an example of this, we can look at what happens if the money supply increases. And if you look at the equation, you can see that an increase in money supply will shift the LM curve down. What does that mean? That means that the interest rate will fall for a given level of production, because now people have more money, and that means they are more willing to lend that money, and that will push down the interest rate. So if we were initially had this LM curve and this IS curve, we had initially this interest rate I0 and this production Y0. And now with the LM curve lower down, we see that the new crossing point will be one where the interest rate is lower and production is higher. The effect of an increase in money supply is a decrease in the interest rate and an increase in production. And then if we go back to this scheme, we have now figured out the shift. LM shifts down. We found that the interest rate falls and production increases. Next is the economic explanation. Well, what happens? Well, of course, as you increase the money supply, people have more money, they are more willing to lend that money, and that will push down the interest rate. And as the interest rate falls, that will stimulate demand in the economy, consumption and investment will increase, and then there will be multiplier effects on that, and production will increase. That's basically the mechanism by which the interest rate falls and production increases. And if we then go back to the scheme, what about the other variables? Well, consumption is bound to increase, right? Because the interest rate goes down and income goes up. So consumption has to increase. And investment should increase because the interest rate went down. So we work through that mechanism. And from this, we see that the central bank can control the interest rate by adjusting the money supply. If they want the interest rate to be on some particular level, they can adjust money supply or the monetary base so as to get the interest rate to the level they want. Okay, that was a short introduction to Chapter 8 on the relation between the interest rate and production in the short run. In this chapter, we looked at the short run, meaning that we took the price level as given, and we assumed that production was determined by demand. And we analyzed the goods market. We derived the IS curve that shows what production will be in the goods market for a given interest rate. We derived the LM curve that shows what the interest rate will be in the money market for a given level of production. We combine those to the ISLM model that we can use to analyze how various exogenous shocks affect the economy in the short run. There are a number of shocks you can analyze and which are discussed in the chapter. So good luck with your studies of Chapter 8.